Good morning, folks. Welcome to a very special opening playbook on Tuesday, September 30th. We will be hosting a very special roundtable discussion this morning looking at Q4. And we have very special guest, Stephen Ground, here, who's going to be hosting the roundtable for us. Hello, Stephen.
Hey, David, how are you doing today?
I am doing great. How are you?
I'm pretty good. It's an interesting day in the markets, and I'm glad that we have everybody coming together today for a lot of predictions, a lot of great trade ideas. I've gotten a preview of everything. I think folks are going to love it.
Yeah, I noticed like the SPY can't decide like which way it's going this morning. Obviously it's below yesterday's close, but it's up down or down up down. And I know we have the threat of a looming government shutdown. What do you think about that?
I think it's bizarre. I don't know really who it benefits on the political side of things, but I guess that's really not what we're here to talk about. I think from a market side of things, I'm not really convinced it'll be a massive deal, only because I don't know if that's what the market's super concerned about right now, but it could happen. I mean, it really could send some things going crazy, and I think we'll see some, maybe a confirmation of trends that we're already kind of expecting, which would be like stronger crypto, stronger metals and stuff. But I'm really going to let our experts kind of weigh in on that, and I'm sure they will dive into that plenty before we are done here today, because it is definitely a topic on the front of people's minds.
Yeah, I noticed I think this year since and this is just my general feeling, like since the whole tariff thing, in like Q2, I feel like that kind of raised the bar on what is going to set people, you know, really, really worried or really crazy.
Mhm.
Like I think it desensitized people to things like, oh, we might have a shutdown. Okay, we might have a shutdown. Like it's all right. As long as we're not, stopping trading with the entire world, we'll be fine.
Yeah, I mean, I think there's a lot of truth to that. I think, and I don't mean this politically at all, but I think Trump's administration kind of generates chaos, whether you're a fan of that chaos or not. I think as a trader or investor, you just kind of have to be prepared for it, and you just absolutely can't ride the waves of the headlines like you might in
Right.
another administration, because you'll send yourself crazy, which is not going to be good for anybody's trading. So I think the market's got more resilient, especially since Liberation Day, as you said. It takes a little more to spark those kind of massive panics, and I definitely don't think, personally, I guess we'll see if our experts disagree here in a minute, but I don't think that the government shutdown risk is going to be the thing that leads to that kind of a panic. But
Yeah.
we'll see. I guess I also still think, my gut says there's still a 60-70% chance that they avoid it, because they almost always do at the last minute. But we'll see.
Well, obviously I spend a lot of my time with Nathan and Graham. They're both fairly bullish going forward. Nathan is generally fairly bullish, and Graham did a whole thing yesterday
Hmm.
on opening playbook, just kind of outlining that as things keep creeping up, even his gut tells him like it's got to tank at some point. Like we've got to see some major pullback, but like all of the research that he did and he presented yesterday on opening playbook just makes a really strong case for the fact that like numerous things have happened that are almost always followed by a very bullish 12 months.
Yeah.
And it's just really interesting to see, obviously you can't fully predict what's going to happen no matter what, but when you have several really strong indications that like every time there's this type of rate cut or every time there's this happening and that happening historically, uh you've got a very bullish next year. uh it's hard to deny like the history of that happening and the odds of it happening again. So it really feels counterintuitive that we're hitting all these highs and yet it's going to continue to go up. But I mean, Graham made a really strong point for that yesterday on opening playbook, so be interesting to see.
Yeah, I definitely think, when we look at the whole picture of everything that we're looking at, from the start of the Trump administration. If you just kind of ignore the week or two that was Liberation Day and the chaos after that, we're up about 10.8% from January 20th when he took office, which is definitely nothing, extraordinary for a first year president. So I think there's kind of that, just because we've been so red hot since April, or since, mid-April, when the chaos ended and we started to recover, it's, start to finish been a more normal year. So I think personally, there's that factor as well. It's not necessarily that big of an outlier. It just feels like an outlier because Liberation Day, had one of those kind of record sell-offs that led to a lot of chaos and then recovery. So
Yeah, it's a good point. Yeah. Well, we'll see what the real experts have to tell us in just a few minutes. For those just joining us, welcome to a very special opening playbook. We usually play the theme song. Maybe we should do that real quick, and then we can get everybody in here.
that works for me.
All right, let's do it.
Flip the page, it's time to start the game. Graham and Nathan calling out the names. Opportunities knocking loud and clear. The market's playbook is finally here. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like the razor blade. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk side. Options in place in a live display. This is where the big plays are made. Oh, charts are lighting up the morning sky. They spot the trends with the hawk side. Options in place in a live display. Every move counts in the game they play. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, step by step they break it down. No confusion, no spinning around. With every trade they set the tone, making big calls on their trading throne. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh, this is where the big plays are made. Oh. Opening playbook, we're ready to roll. Daily moves that fire up your soul. Strategy sharp like a razor blade. This is where the big plays are made. Oh.
Good morning, everyone. Welcome to a very special opening playbook for Tuesday, September 30th, 2025. We are going to have a very different session this morning. We are going to be holding a roundtable to take a look at expectations for Q4. And of course, we will have our regular host geniuses, Nathan and Graham, but we will also have a very special panel of, dare I say, even smarter people. We will have Alex and Jack and Kane and Jeffrey here with us as well. But we also have the wonderfully smart and beautiful Stephen Ground. Let's bring him on. Hello, Stephen.
Wow, I've been asking people to call me wonderfully smart and beautiful for so long now, and your check will arrive in the mail shortly.
Wonderful. I do it just for the money.
Yeah, I'm sure you would have to. Hello, everybody. Welcome to a really special opening playbook roundtable here. I'm very excited for what we've got for you today. We've got a Q4 predictions from all of our experts on a variety of topics. Each of them has also sent along a trade idea that they're going to be sharing today. And if you want to get a special little handout with all those trade ideas tomorrow morning, you just want to make sure you're signed up for the New Money Crew newsletter, which I believe Dave has the link he can drop here in a minute. I'm sure a lot of you already are signed up because you're here on the opening playbook every day and get that newsletter. But if you haven't already, you can sign up for that and make sure you get the trades tomorrow morning. But also, you can just stick around and take them with us live or write them down for your future consideration, because we're going to dive right into it all.
All right. Well, let's bring our regulars on, Nathan and Graham. Hey, guys.
Well, hello. How are you? And happy Tuesday. It feels like Monday to me because I was missing in action most of yesterday, but hope everyone is doing well. Got another interesting market here with, quite a bit of movement here in the first 30 minutes, and yet we're standing right about 0%. So I think that is somewhat par for the course as of late.
Yeah, we just had good jobs numbers, good consumer confidence, and we are still negative 0.2 on the day. So
on the way up, though, from
about as boring as it can get so far.
Well, I mean, I don't know about you guys, but it feels insane to me that we are having this roundtable right now with the last day of Q3 already here, and looking at Q4 just kind of breaks my brain a little bit, but I'm excited about it. I got to preview a little bit of what everyone has to share, and I think it's going to be absolutely value-packed, action-packed, lots of trade ideas, lots of specific things to look at and watch for. And then, of course, I am a little bit personally biased and more excited because I've got something extra to layer on top. So excited about this session, and just ready to get rolling and dive into the good stuff.
Awesome. Well, Stephen, what do you want to do first?
Well, we're going to get right into it with Graham here. One more piece of housekeeping. Well, two more pieces of housekeeping wanted to do in advance. Last roundtable, we kicked around the idea of doing a trivia session for everybody. It's just to have a little fun, give away some prizes and such on an evening. And we're going to actually do that next Tuesday. David and I are going to be hosting that, so we can drop the link in the chat. You do need to sign up for this only because we want to be able to send you the message to remind you that you should come to this, and we need you to sign up to do that. So if you sign up there, you'll get a chance. We're going to give away, Nate, I think you said you're putting up over $1,000 of your own personal money on the line for this. I heard, I don't know, but there will be over $1,000 in total cash prizes, and it'll be a lot of fun because David will be there. So sign up for that. And then, like I said, New Money Crew newsletter. We're here in Opening Playbook taking over their time slot. And we want to make sure you're there every morning. The best way to get that is the New Money Crew newsletter and SMS page. So I think that's it. Graham, I want to get into you and what you have to share here in a second, but I do want to read a disclaimer before we get started. You'll notice some changes to kind of the flow of how we do these roundtables today. I think they're really going to make them smoother and more exciting for everybody. But if you like what you see or have any suggestions, we're always open in the chat. First and foremost, though, when we talk about trading, you should know the profits and performance that we're going to see are not typical. We're not making any future earnings claims. Obviously, you can lose money when you put it in the markets. Every trade example you're going to see today, especially when Nate and Graham get into it later on, is from real trades sent out to students in real time. There's no back testing or theoretical data. The average return per trade is 3.35%. per overnight trade, and an 81.2% win rate with an average winner of 24.5%. Every overnight options trade targets roughly $613 in income based on a $2,500 starting stake. You're going to hear more about that a little later, but first we've got Graham, who is a regular host of Opening Playbook, so I'm sure many of you are familiar with him. But
hey, I'm just going to interrupt you real quick. I'm going to leave to make room for everybody else and bring them on right now.
Sweet. Perfect. Appreciate that. Graham's an options expert with over a decade of experience in the market. He studied technical analysis under two of the top minds in finance. He developed and popularized wrap orders, which I'm sure many of you are familiar with. And, he started the 60-minute trades, which I've been taking and loving, just speaking for myself. And as I've said, he hosts the opening playbook every Monday through Friday from 10 a.m. So Graham, welcome. Thank you very much. And I think we'll just dive in with the first question I have for you, which is what, are the major trends that you're looking for coming up in Q4, which, as Nate said, I can't believe is actually here.
I know this is the end of Q3. Tomorrow we start Q4, and it's an exciting time to be a trader. Just looking historically, just broad market, any year, any time, historically, on average, it's the best time to be a trader. Quarter four is the hottest in the market, October, November, December. It's a great time to be involved in the market. So kudos to you guys to being here right now. Now, there's a couple of charts I'm going to show you guys. If you've been coming to the opening playbook, you may have seen them before. If not, I highly recommend taking screenshots of them. The first one here, going into my prediction of what's to come, is we want to look at what's happened in the past. Not to tell us apples to apples it's going to happen exactly that way again, but it gives us a good roadmap of maybe what to expect. So just the other day, we had the Fed do an interest rate cut when the markets were within 2% of all-time highs. So markets are near all-time highs. Things are looking good, and here we are cutting rates. With that said, whether you like the cut or you don't like it, let's just look at the data here and see what that has to say for us. So when the S&P is within 2% of all-time highs and we get that cut, what does the market typically do? Well, if we look at that first column here titled Next Month, you can see there's some volatility there. There's some good months and there's some bad months, and normally pretty good sizable moves. Not trading by two directionally. Recently about how structuring the two-way options, going playing both ways, how that can work really good over this month, and that's important. Next 3 months, which would be pretty close to quarter four for us, you can see 77% of the time the S&P went higher. Let's go ahead and go all the way to the end there where it says next year. This is what I really wanted to point you guys to. We got a lot of people who are actually, it's a mixed bag between bulls and bears that show up to our show every day. But I just want you to look at the data. Let's check our emotions at the door and see what typically happens over the next year when the Fed cuts rates within 2% of all-time highs. Well, you can see there's been about 20 instances in the past since 1980. In each and every time, 100% of the time, markets have finished higher over the next 12 months. And we're not talking about finishing 1 or 2% higher here. We're talking about, on average, about 14% over the next year. So that's where my head's at right now. I think we've got a lot of excitement with the AI catalyst going on. I know that it is sort of looking a little bit like a bubble. It may end up being a bubble, but I don't think we've seen that blow off top just yet. And if you skip to the next slide, we can talk about this current run here that we're seeing right now. So right now, this is the fourth strongest rally versus all other bull markets following a 20% market correction. Right now, you can see that black line is our current market. And if you've been coming to the show, you know that for the last 6 weeks or so, I've been saying, I think we're going to have a pullback. This looks crazy. There's no way this can keep on going. But if you actually look at the data, I think I would retract that statement looking back here like a Monday morning quarterback, because actually that line there, that black line is quite short compared to some of these other runs that we saw before seeing an 8% correction in the market. So on average, these early stage bull markets last about 260 trading days. That's almost a full year until we see an 8% correction. So we could very realistically go another 6 months before seeing a major 8% pullback. That's just something to keep an eye on when we talk about checking our emotions at the door. Again, I am guilty of this. For the last couple of weeks, I've been looking at it and saying, this is crazy. This cannot be. But historically, we know that this thing can just keep on going when the momentum is hot. If you flip to the next slide here, here's just a visualization of this since those April, the tariff scare that we had. Here's every pullback, if you will even call it a pullback, in the S&P since April. The biggest one has been 2.93%. That's the largest breather we've gotten in the market over the last 6 months. Now, according to Goldman Sachs, about 2% of the S&P has been shorted, which, get this, is the highest level since 2019. Now, you could take that on face value and say, well, maybe Wall Street thinks that we're going to have a big crash. Or you can look at the data of the past of when the Fed is pumping, steroids into the economy, when the stock market's really hot, and you have a higher than usual short interest. What happens? Well, typically we'll just see more micro squeezes, if you will, on the S&P, where the shorts are hard and heavy. It starts going against them. They have to cover, and that just adds fuel to the fire of these rallies here. And we'll jump to the next slide as well. I'll keep flying through this. I'm packing on the data here for you guys. Steven, did we miss one there? I'm not sure if we missed one. Oh, no. All right. Okay. Well, there's your seasonality chart of the S&P, October, November, December. Like I said at the start, historically, very, very good time to be invested. If you go to the next slide here, you'll see the presidential pattern. This is historically what happens in the first year of a presidential term, which we're in right now. Pretty rocky up until this point. Now, we've had a pretty great year all in all. Now, if you asked, and if I said this in March, you'd say I was crazy. But looking at the year in hindsight now, it's been a pretty great year. Well, historically, the best is yet to come for this year. So that's kind of where I'm at right now for the near term. I think we're going to continue to see the bulls take control. I think we're going to see the markets continue to melt up over the next 12 months, maybe longer, maybe a tad shorter, but around 12 months, like we saw with the data there, when the Fed is cutting rates, when they're just stimulating the economy, we're adding steroids in, and I think it's just going to keep on running with the money supply growing there. Another little food for thought for you guys outside of just the S&P here, if you go to that next chart, the gold super cycle that we're in. Right now, if you look at the relative strength of gold over the S&P 500, it's crossed above zero for the first time since the dot-com bubble, since 2001, actually. If you know anything about gold back then, it ran like 600%. What about the time before that? That was the 1970s, stagflation. You can see those red highlighted bubbles there. What happened to gold then? It went crazy. So right now, even though gold is very, very, it's gone very, very, made a crazy run up, 3,800, almost 3,900 now. I don't know if it hit 3,900 today. I know we were getting close. But even so, let me just look. High price, we got 80 cents away from 3,900. Even with gold as crazy propped up as it is, this chart tells me that there is still room to run. And while $5,000 an ounce of gold sounds absolutely ridiculous, it could definitely happen. So you definitely want to be involved with gold over the next 12 months. Also, I can go into a whole spiel about how interest rate cut cycles are very, very good for gold in both recessionary and non-recessionary environments. We don't have the time today, but definitely want to be all eyes on gold. And then last but not least here, I think we've got a really awesome window with Bitcoin on that next chart. If we look at Bitcoin seasonality here, October, November, December are the best times to be long Bitcoin. We know that this cycle has been a very, very good cycle. I gave the prediction point of saying, I think this was in February 2023. I said, I think we're going to go to 125 to 150 a coin, roughly speaking, $150,000 is my high end range. Now there's been higher projections, there's been lower ones, but that's where I was kind of sitting. And now we're almost there. With that said, there's still a good room for running here. 20-30% on Bitcoin here over the next 3 months, I think is totally reasonable. I'm going to give you an options trade on it. Now, this, in my opinion, could be the end of the cycle, but it also could not be. If we get this melt up with interest rate cuts, we have the ETF inflows, it could just keep going. But with that said, over Q4, I am very, very excited to be taking advantage of Bitcoin. So here we've got a trade for you guys that we'll post here in the chat. We've been taking in the opening playbook. So you might be a tad late to this one at the moment. We didn't even show a debit price. So I don't even know exactly how much it's up since then. But we'll go ahead and post this in the chat for you guys if you want to roll with Bitcoin over the next quarter. Now keep in mind, I highly recommend showing up to the opening playbook each morning at 10 a.m. Because if you have been showing up, you know that I actually would like to see Bitcoin at about 106, 107 before really gearing up here. If you look at a weekly chart of Bitcoin, that's where the 50-day or the 50-week moving average is. And it typically, when it touches that, makes the next run up almost immediately. So I'd love to see that for extra high conviction opportunity. Either way, things look really good there, in my opinion.
Awesome.
Hope
Graham,
I finished in time.
Yeah, you were good. I found your missing chart. Do you want to cover that real quick? I stole it from you.
Yeah, it's just more bull case scenario here for us in the S&P. Again, I expect over the next year for it to go higher and higher. I expect it to be red hot. Do I look at the chart now and say, wow, this makes a lot of sense? No, but I look at the data, and that's just what it says. So here's just another chart for you. The S&P 500 is up, just finished up, unless something crazy happens today, which it hopefully doesn't. But by the end of today, we'll have finished up 5 months in a row. A year after 5-month win streaks, what does the S&P normally do? It's higher 28 out of 30 times with an average return. That's including that loser. An average return on the S&P over the next 12 months of 12.6%. So 93% of the time, it goes higher over the next year with a 12% average return. Those numbers are eerily close to that stat I gave you on the rate cuts. These are going hand in hand. The stars are sort of aligning here for the S&P over the next year.
Awesome. Thank you so much, Graham. That's amazing insight there. We've got that trade in the chat for everybody. And just to keep it moving here, we'll go ahead and bring on Jeffrey Turnmeyer. Jeffrey, been a while since I've been on a roundtable with you. So thank you for being here. Welcome back. Anybody that doesn't know Jeffrey should get to know Jeffrey. He's a civil engineer, a market savant. He's been fascinated by trading since elementary school. He grew his own family's accounts to over 1.4 million during COVID, and he's a crypto expert who's helped even advise on mining projects and facilities. Plus, you do everything else under the sun there, Jeffrey, as well. So thanks for being here this morning. And why don't we dive right in? Because I know you have some opinions on crypto too, and maybe some secondary opinions. So what are you thinking about the market right now?
Yeah, so commonly held that September was a bad month for Bitcoin, but pulling up the seasonality chart in TradingView, there's only 4 years that it's been down in September. 12 years it's been up in September. So I'm not sure where that statistic comes from for September being bad, but November is actually kind of a flip the coin month, and October is kind of like not as good as September. So maybe we have a little bit of wishy-washiness into the end of the year. Now, look at the Bitcoin cycle. In case you didn't know, we work on these cycles where every 4 years the payout reward for miners gets cut in half, and we had that go through last year. Now, typically after a halving event, we run for roughly about a year and a half, maybe a little longer. Well, that time for the run to end is coming up right here in October as we stare down the next couple of weeks, and we could be entering crypto winter. So we may have already topped, even though we didn't have the performance on the upside that a lot of people were expecting. Maybe we didn't have that because everybody was expecting it, and we might have already topped and be staring down the face of crypto winter. So if you're not prepared, you don't have exit points on your chart already, might be a good thing to start adding those alerts. If we break through 100,000, odds are we're probably going on down further. And this could be back down in a $30,000 to $40,000 range where we bottom out. I know it's not going to be a popular opinion for a lot of people, especially if you're long Bitcoin or crypto related assets, but this is one of those things you need to think about. All right. I don't always want to be the contrarian, but that is very real possibility right now that we have already topped in this Bitcoin cycle, just time wise. And the move came up to some of my fib targets, not to the ones I expected, but it's very real possibility. Now we could also pull back right here, touch 100,000, maybe even just slightly lower, and then rocket out to a blow off top. That also kind of corresponds with what I might see in the S&P right now. Things are looking a little overcooked. We could use this government shutdown this week as an excuse to pull back. And one thing that got my attention, I didn't have the opportunity to send you any of these charts, but last night I was digging through some stuff. I found a $12 million order that somebody bought over 150,000 calls on VIX at the 32 strike in two big orders worth $12 million.
Wow, that's huge.
And so right now I'm looking at playing some UVXY, maybe late October, like the 24th, maybe like a 14 strike call. Probably going to look to add some of that, maybe around a 50 cent cost for me, because that is a 2x leverage instrument on VIX. I made a lot of money during COVID using this instrument, and upwards of about a third of the money I made during COVID made with VIX and UVXY. And I'm looking at that call. It could possibly go up into the 30s, just a normal pop on VIX going to that 32 strike that somebody bought 12 million calls at. That would return like 200% on UVXY right now. So it'd go from like a $10 cost to 200%. We're looking at 30 potential on UVXY. So if that 14 call went to 30, that'd be like $16 in the money. You spend 50 cents on it. That's a reasonable return right there.
Not a bad return, I would say. No. Kind of your bread and butter with VIX, right? Is turning those massive returns. So that's impressive.
That's a way to play. And then the last few days, week and a half, I've seen massive call buying going through on Tesla. I know a few people that work at Tesla. They've been telling me that their car sales are just ridiculous. with people trying to get in this EV credit before it expires today. If you don't have your EV credit locked in, you've got till midnight tonight to go sign a contract at a EV dealer, Tesla, whatever, get the Tesla app and lock in that discount. IRS says, as long as you have money down on the table, you can claim the rebate. And, but I've seen massive call buying going on in Tesla the last couple of weeks, like millions. Yesterday, I think it was $8 million worth of upside calls through January. And my way to play that, just buy some TSLL. That's a 2x leverage on Tesla. I'm just buying shares. You could sell puts below the current price and pick it up for a discount. You could buying calls on something like this is a little bit dangerous because there's no guarantee it does anything when they put out the car sales numbers later this week, car delivery numbers. But the car delivery numbers aren't necessarily going to be all inclusive. People just had to sign a contract. They can take delivery next week, 2 weeks from Tesla. So that's a big upside opportunity right there that I brought for everybody. That's the one I kind of planned out. The VIX thing, kind of a surprise. Late in the show there. So those are one of my opportunities right now. As far as the market, I think we could be in for a little bit of volatility, especially with that VIX contract coming through. That's kind of somebody having a good feeling that something's about to go down.
Yeah,
literally.
Yeah, absolutely. And I think
now that pullback in the S&P can set us up for the blow off top that Graham was looking for into early next year, and can take us higher, and then we can meet that ultimate top wherever it might be.
It's coming somewhere. Gotta be. Awesome, Jeffrey. Thank you for the insights. That UVXY trade is a great idea. I love that. I love that you spotted that. Thanks for sharing it.
Hey, a bunch of people are asking in the chat if you have a specific trade rec for UVXY.
I think I dropped it in there, right? It was the 24.
It was 14 strike call. I can throw in the chat when I'm a 14 strike call for October 24th is the one I was looking at.
Perfect. That's awesome. Thank you for that, Jeffrey. Appreciate it.
Yeah, no problem.
Love it. All right. Well, we're going to bring in Kane here next. And Kane is a former PIMCO VP portfolio manager, helped manage $1.7 trillion in assets for companies like Disney, Apple, Google, and more. Traded $200 billion in daily volume as well, and has worked with some of the greatest minds in finance that you hear about all over the place. Kane, I know you're a veteran of these roundtables now, so maybe you don't need any introduction, but pretty impressive resume there nonetheless. Thanks for being here.
Yeah, thank you. I might have an impressive resume, but I got to say, I don't have my own theme song. So I think Graham and Nate have me one up there. So.
We got to work on that. Absolutely. So diving in right with where we, want to pick up, what are some sectors that you think might lead the way in Q4?
Yeah, that's a great question. So we recognize that we are currently in a very bullish cycle. It is always smart, especially when it feels like we might peak sometime in the next year or so. We might be peaking, or there might be a bubble burst. So what Jeffrey was warning about, the UVXY type of trades, those are great hedges. I wouldn't be putting like a huge position in that, but it's definitely smart to have something there in protection if you have a portfolio. If you're just holding one or two positions, then that's sort of like a lotto trade. At least that's my viewpoint and the way that I approach things. So the sectors that are very strong right now that we're specifically looking at right now is very strong right now is lithium and EV. So Jeffrey was talking about that Tesla trade that he gave was amazing. And what we see is that lithium and EV are showing up in every single time frame that I track. So that is 1 day, 1 week, 1 month, 2 month, 3 month, and 6 month. They are leading sectors. So these are really hot sectors right now. Money is moving into it continuously, even on a daily basis. So those are definitely sectors to look for during Q4. I do believe that money is going to continue to go in there. And then longer term, so we see these not in the 1 day and 1 week, but we do see them in the 1, 2, 3, and 6 month. Nuclear and mining and metals are also very, very strong. And I expect them to continue to be strong to the last quarter. An up and coming sector is crypto. So no surprise that we've got the seasonality that Graham told us about. We've got a potential winter that Jeffrey told us about. But as of right now, as of today and yet yesterday and the last week, money has been moving into those cryptos. So it could be one of those situations where, hey, you have a run up and then it pops, or you just have to watch it very carefully. And that's what trading is about, is getting the timing right, as opposed to maybe investing and holding something for a really long time and holding it through these types of drops. So as traders, we want to be aware and we want to watch that very carefully. So we are also seeing it show up, interestingly, on the 1 month and 6 month basis. So that implies that there is that is up and coming. There was interest over the last 6 months, but in the nearer term, that interest is picking back up. And so I think we'll see, at least in the beginning part of Q4, we'll see some good run-ups in crypto.
Very interesting. I like that we have some contrarian opinions on crypto, because it's not always the easiest to predict. Kane, I'm curious, because you have kind of the institutional background. You've worked with so many impressive people. We're in a very interesting environment right now. We just had a rate cut a week or two ago. Now we're looking potentially at a government shutdown as soon as tonight. What do you think the institutions are doing right now entering Q4? How are they going to play what seems like an insane trading and investing environment, I think, to be from a lot of people?
So I'll tell you, from an institutional standpoint, it's all about expectations. And so do we as institutions, or do we as the people who control large amounts of money, do they actually expect the government to shut down? And my answer is probably no. I don't think so. I think if I was still at my seat at PIMCO trading, I would barely be paying attention. I wouldn't be paying attention until tomorrow, if it looked like they were actually going to shut down. I guess it would be the Wednesday, or today's Tuesday, so it would be Thursday, right? So they have until tomorrow to decide if they're going to shut down or not, and then the reaction will come on the day after. So right now, as you can see from the chart on the screen, it's not priced in. A shutdown is not priced in. Even if it was priced in, we've only had one really long shutdown in history, maybe two, and ones that lasted more than, say, 3 to 5 days. So there's been one that lasted over a month. That was, I think, if I'm 2013-ish or 2018, and then there was another that was probably like 20 days. So in general, even if we shut down, it's only for a couple of days and doesn't have a huge impact on the market. And we're seeing that in the levels going into the end of the year. What you're looking at right now is gamma levels. So those are options bets by players in the market, and also where the market makers have their risk. And right now it's not showing any sort of risk of a shutdown. So especially last week, we had that bounce off of the EMA 20 and the S&P 500. And so that was very bullish. And today we're just kind of crawling and creeping along that EMA 8. So technically, everything is looking very bullish and very strong in the short term as well. We have our gamma implying a 675 on the SPY, which is bullish, but it's not as bullish. What we had before quadruple witching is we had a lot of exposure going all the way up to 700. So after options expiration and after the rate cut decision in September, we did drop a little bit our expectations of where that market could go. And that's mostly because of what came out of the rate cut, the dot plots, and our expectations of, are we going to get 2 more rate cuts by the end of this year? So right now, the probability of 2 rate cuts is about 68.2%. That was yesterday. Today, it's going to be very similar today. And that's down from 75.4% last week and 82% 2 weeks ago. So our expectations of the market just running up like crazy up into 700, that has diminished, and that's why we're looking at 675 now, or 675. Yeah, 675. So let's take a look at the dot plot. So we see the median right there. That's the expectation of 2 more rate cuts by the end of the year. that is the median, but you can see there's just as many votes above that median line as there are at the median. And there's even a few there that are like, oh, we might actually increase rates. So there's definitely not agreement on everyone from the Fed. And that's the dichotomy between the unemployment situation and the inflation. Right? So let's talk about one of my favorite setups. So I did mention crypto and mining are two of my favorite sectors heading into Q4. So I was looking at CDE, and yesterday when I was looking at it, the timing wasn't excellent, but this morning it actually opened right at a key level and then bounced off of it. So CDE is looking good. I don't have, unfortunately, a recommendation for you because I wasn't expecting the timing today to be to be great, but you can take a look at that one on your own. I know, of course, if you like the equity, you could just buy the equity. And today I'm looking at a crypto mining stock, which is BMNR. So it has a strong gamma pocket overhead at 65 and at 70 and at 80. So we're talking about near term. Does look like the market is positioned for BMNR to go up to at least 65. And it is developing a potential institutional accumulation pattern. We'll see. It's not guaranteed yet, but when you see a stock hit a level and then come back down and then hit the exact same level and then come back down and do that multiple times, but each time it comes back down, it is more shallow than the previous one, then that is an indication that an institution might be accumulating that stock. So right now we do see that developing, and it is breaking above its year-to-date and quarter-to-date AVWAP, and so that is a nice entry point for BMNR. So here's the trade. It's a little pricey, so you could just go in to the options are a little pricey, so you could just go into BMNR shares or if you want to trade options, then I would spread it because a single option is, I think, over $1,000. So you could buy the November 1st 50 strike and sell the November 21st. I said first, but November 21st 55 call. That would create a debit spread. And you target a price around $1.70, maybe $1.80. Definitely under $2 would be my target price.
Awesome.
And then I always love giving the full trading plan, not just, oh, buy this. So you would exit when you hit the first gamma pocket at 65, or and then you can hold runners because it might go up to 70 or 80. But as a debit spread, you don't really care how much it runs up, just that it runs up. And then as a stop, you would close if we're wrong and it breaks below the MA50.
Excellent. Thank you for all of that, Kane. Appreciate that. Your insights are great. And as a reminder to everybody, we're going to have all of the trades put together in a little handout tomorrow morning. It's going to go out in the New Money Career newsletter. So if you want to sign up for that, I'm sure David could drop the link there as well. Thank you, Kane, for your insights. Really appreciate those. Thanks for being here as well. Alex, we're going to keep things moving with you. For those who haven't met Alex before, he's been trading and investing since 2018, studied econ in college before graduating to test trading strategies for $1 billion financial research firm. He also called the Silicon Valley Bank collapse all the way back in 2022, naming it portfolio poison and potentially saving traders from 100% loss. And he's been calling Palantir for a long time, which, as we've seen, I'm sure it's up much more than 691% since then at this point. So Alex, thank you for being here. Really appreciate what you're doing here today. What are some of the trends and things you're looking for in Q4 that folks should know about?
Yeah, so stocks are cool and everything, but I heard that theme song, and I gotta say, Nate has a great voice.
That is, I'm glad you figured out that.
Thank you, Alex. I did all the instrumentals in my garage as well.
That's beautiful.
Next week we're recording the version with all 18 of his kids in harmony.
Oh, get the full orchestra in there.
Yeah.
Yeah. So, as much as the past can be an indication of the future, right? If you look at on average, October has typically been up. But it's been calmer than other months outside of some of the summer months, and we're kind of gearing up for either the December holiday rally. right? Holiday rally starts just like in the Christmas decor and Michaels. They start earlier and earlier each year.
Probably already.
So heading into November and December on that. What's interesting though, like if you go back to 1950, right? I mean, we're just dealing with different market paradigms, structures. If you kind of narrow that gap just to the last 10 years, right, through last year, obviously, basically 2014 to 2024, December has actually, you know, been sort of a letdown in terms of returns for that month. But October and November have been strong, which is interesting. What's interesting too is, you know, September, right? Everybody was gearing up for September to be a down month, and we touched the 20 EMA, and then we've just been rallying. So it's different now, right? I mean, we're not seeing typical historical trends play out the way they have in the past. Things are changing. We do have the government shutdown looming tonight. I know Kane said didn't think it was happening. I personally think that it might happen. How long will that go on? I don't know. Like I live in the DC suburbs.
So so you guys know, one of the instances where it did last longer than a few days was under Trump the first time
Right,
over the border, over the border wall.
Yeah, so I think that was 19 days. So I live in the DC suburbs, Northern Virginia. Seems from what I can gather from my on the ground intel from some people who do work in the government, looks pretty likely that we will have a shutdown. To what extent it matters for the markets remains to be determined, or even to the extent of how long it lasts. You know, these are probably market odds, right? I think it's interesting. I think these are pretty indicative of future events, like the hive mind. At the end of the day, though, a lot of times, these games of chicken for the government shutdowns are just, you know, kabuki theater. Nothing really happens. I did put a poll in my Telegram yesterday. Most people were in the nothing ever happens crew, so they do not think a government shutdown is going to happen. I do. I think the chances are pretty high at this point. It was 60% yesterday, 86% now. Actually, I'm looking at it, ticked up a little bit even since I took that screenshot. So that remains to be seen what happens. But if it does happen, you know, September, right, was a great month for the markets overall, and shaping up to be a good month if we can close out this last 6 hours here. It might be a catalyst for a red October. See what happens though, and regardless, especially if, right, if the markets turn red in October, the government shuts down, I do think that the future for the rest of the year and beyond even is going to be materials. So I have silver here. Let me just, before I get to that, I want to say nuclear, really long nuclear companies like NEE. I just saw this morning after I created this deck. Next Era Energy secured a 20-year license renewal for its Point Beach nuclear plant. Extends operations to 2050 and 2053. So this is in Wisconsin, powering 1 million homes. So I could see NEE, you know, looking at the chart, we could get to $80. It's at 75 now. We could get to 80. I think we could actually touch all-time highs. So this nuclear is not going anywhere. It's going to be important. Any of the material stuff, right? Gold, silver, palladium, actually, even, which palladium is actually used more in electric vehicles than any other material. So focus on materials, focus on the stuff that the energy sources, right? We're looking at the government taking stakes in mining companies like MP Materials, Lithium Americas, right? The race for resources is on. Silver, gold, palladium, lithium, nuclear energy, all this stuff, all going to heat up. It's all going to continue for, I think, the foreseeable future, years away, definitely for the rest of the quarter. I do think silver, though, is heading to $48. I think we got a good $48 push coming up on silver. And there's a pretty good little trade. It's pretty cheap right now. We can do for a pretty good ROI on that. So this is a debit spread. Now it's out of the money. So what we're looking for, if silver hits, 47.50, 48, if you buy the $46 call, you sell the 21 November $47 call. When I looked at this, it was 20 to 80, so that's 400%. Right now, we're looking at you can get in for $18. You can make a max profit of 82. So if it were to expire, if this contract were to expire, November 21st, over basically 47.50 at 48, you're looking at a 456% return on that. And just not looking, I'm not really, especially look, if the government shuts down, it brings up a ton of issues with, the government's efficacy, the bond markets, all this stuff. Gold's already been on a historic run. And silver is lagging. It usually lags gold. So we have more room to catch up on silver. Gold is still spiking. Silver is going to be following. And it's a lot cheaper than gold. And SLV is a lot cheaper than GLD. And I think this play could work out. We have plenty of time for it to work out, basically right before Thanksgiving.
I love it. Thank you. We've had silver been very popular call on these last few roundtables because Jeff was all about it right after the rate cut. And I think it makes sense, especially now with the government shutdown. Thank you, Alex, for those insights. Love that trade idea. I'll probably jump in on that one myself here after the webinar because I'm pretty bullish on silver as well. Turning now to Jack Carter. Jack, thank you for being here. Glad you're here. If anyone doesn't know Jack, which I doubt, but this is the man we call the income ace based on his nearly 40 years of experience generating premium. He's got a background on Wall Street. He was trained at the World Trade Center. He managed his own funds so successfully that it never saw a losing month on record. Incredible track record and a lot of great resumes on today's roundtable. And Jack, the market feels insane right now. Either way, even if you're bullish or bearish, doesn't really matter what you're expecting. It's pretty crazy right now. So what are you feeling in the markets? How are you looking at things? And what are the best ways for folks to maybe approach pulling some cash out of this market right now with things being a little topsy-turvy and hard to predict?
Thank you, Stephen. Yeah, I don't pay too much attention to seasonality and going into this last quarter. For example, September is typically down about 0.75% from the last however many decades you want to look at the month of September, but it was up 2.5, NASDAQ up even more. So I'm not looking at too much seasonality going into this last 3 months. This is a great time to trade, regardless of it's up, down, or sideways, because the premiums in options are just so high. It's crazy. Now, the other reason I don't like to predict what the next quarter is going to be is because when you look for a stock to trade, there's really just two ways to go about it: fundamental analysis or technical analysis. With fundamental analysis, the analysts and investors are reading all the information, quarterly reports, press releases, annual reports, the whole 9 yards. And from all that reading of the fundamentals, they try to predict a stock price. Now, technical analysis is reactive, and that's what I like about it. So there's no predicting. I react if I see a stock that's doing what I want it to do trend-wise. I react by either buying that stock or setting up an income type trade. And that's my thing. I like the income trades. And also going into these next 3 months, we talk a lot about stocks, but I think strategy selection is more important than stock selection, especially in these last 3 months, because no matter what happens up or down, it's going to be volatile. And that volatility is going to jack up the prices on options. So this is a perfect time to find even just one or two stocks that are trending higher. Because once you have that, then you can do the triple crown of income trading, which is you got a stock in a nice trend, and you can then either buy it and sell covered calls. That's number one. You could sell naked puts. That's number two. And then you could do credit spreads. That's number three. You can do all three of those income strategies on one stock as long as it's trending higher. So I'm not really going to predict anything. I think this market's going to go higher. I'm looking for some kind of a scare, not really a black swan, but when the market's up like this, it's going to look for a reason to go down. A lot of people are, they'll stay in it as long as it's going up, but they're going to want to lock in some profits. And going into the end of the year, there's a lot of balancing, people taking losses, people locking in gains, things like that. So it's going to be real volatile. But like I say, you don't need much in the way of, you don't even need to buy a stock right now. You could just do naked puts throughout the rest of the year and do great. And without even touching a share of the stock, you don't even need to buy it. The only time you would need to buy one is if you were going to do covered calls. And that's been great too. And there's been so many stocks that have that trend and a good price and a beta over 1. And that's what I look for. A beta is a measurement of the broad market's volatility. So the SPY, for example, it's got a beta of 1. Any individual stock that has a beta over 1 is going to have great options pricing. So if you look at that within the context of a 6-month trend, preferably the stock's also making new highs, then you're set up to do the triple crown from here till the end of the year. And you can just rake in as so much option premium. It's ridiculous. I've never seen options premiums this high in my life relative to stock prices. And I think part of that is due to the volatility, like I say, but the other part is there's so much retail interest in options now.
Mm-hmm.
I've never seen it like this. It's just been absolutely crazy from the retail traders jumping in, buying calls, stuff like that. It's been wild. So I think the market will be up going into the end of the year, but we're going to get a real nice scare between now and then, maybe around Thanksgiving. Like I say, the market's just looking for a reason to go down. Anything could scare people. Now the market's really finicky. So we'll see how it goes going forward. But I'm still bullish just because the market's bullish. I'm not going to make any crazy predictions other than you can make a nice fortune just selling options.
Well, Jack, I know we're going to break down here real quick a potential trade for folks to do exactly that. And I know some folks out there get, kind of spooked by the idea of selling options, selling puts, because they think of it as extremely risky. Can you give the 30-second case for why you love it in a market like this?
I love it. For one is just conceptually think about this. When you're selling a naked put on a stock, you get to pick the price, you get the strike price, you get to pick the expiration. And what's happening is you're getting paid just to make a promise. That's a crazy business proposition. You know what I mean? You got a stock out there, you can pick a strike price $10 below the stock and say, hey, I don't want to buy it at the market, but I promise you I'll buy it if it drops down to the price I want. And I got to get paid up front to take that promise. Where do you get paid to make a promise in the real world? Nowhere. The options market is beautiful. It's willing to pay you every single day the market's open. So the other reason I'm not scared about naked puts is, and you should be scared if the stock is trending down. The trend is the whole thing. If you got a stock that's just chugging along, trending higher, and that's a stock you also want to own. I only do this really on stocks I want to own and stocks that are trending higher. And you'd be surprised how hard it is to actually get the stock put to you on a naked put. I've done this so many times on IBIT, I've lost count. I got a 63 strike price naked put on IBIT right now. I've seen the stocks go below my short put, and I haven't been assigned, and then they've gone back up, and I haven't been assigned at all. So it's tough. When you got a stock trending higher, it can be difficult to be assigned. And the other reason I don't mind the naked put is if I do get assigned, I already got paid, so my actual cost is lower than the assignment price because I took in that premium when I sold the naked put. But if I get the stock assigned to me, I can turn right around and start selling covered calls. Or I can sell the stock right at the market and just keep my premium. It's very hard to lose money with naked puts if you're doing it right. It's real easy if the stock isn't trending higher. You're not going to be able to get out of it. So it's just that simple. It's really simple.
Well, let's look at an example of one on a stock that is certainly trending higher, more than trending higher, and then, one that a lot of people want in their portfolio right now.
Yeah.
So what would you do with Hood here?
Yeah. So this one got away from me, but yesterday it got away from me in terms of the price jumped way more than I expected. It was like 129 and change yesterday, and selling the 120 put that expires November 7th, you're getting 660. That's $660 you get paid, right? Now, if I get the stock assigned to me at 120, my real cost is going to be 120 minus 660, right? Now, if you're doing this on margin, which I'm doing, and that's another crazy thing about naked puts. This kind of flew below the radar of everybody, is that, when you buy a stock on margin, you got to put up 50%. When you sell a naked put on margin, you only have to have 20% of the underlying stock. Like,
Wow.
that's crazy, right? I don't even know why that is, but that's how it is. And so when you have less skin in the game, less capital required to do the naked put, that makes that yield so much higher. Now, listen, naked puts are great on a cash secured basis or on margin. Either way is good. I recommend everybody do it. But look at this, going out to November 7th, this is 28% yield straight up right now, based on what I had to put down. So you're only risking 2,300 or whatever that was, right? I'm looking for a 28% return in 39 days. Now, ideally, I'd like to do this 11 to 12 times a year. So, when this expires in November, I bring in cash flow here in September. I'm not going to be able to bring in any cash in October. But when this expires in November, I'll be able to do it again, set up an expiration for December, and just try to do it, like I say, 11 to 12 times per year. And that cash hits your account immediately. That's 660. You would think you would only get paid that 660 if you were right about the trade at expiration. But with these selling premium, you get paid up front. You get to hold on to the money the whole time this trade's going on. I like getting paid up front, and I just think getting paid to make a promise is crazy. And the other thing is, options can expire worthless. I don't know anything in the business world other than maybe vegetables and flowers that expire worthless. But you got an options contract that contract can expire worthless. So you get paid for something that's going to possibly be worthless at the end in November 7th. And if it's not, I can either buy that put back to get out of the trade, or take assignment, start selling covered calls. Like I say, it's you got a whole triple crown of strategies to use: naked puts, covered calls, credit spreads. That's where the action's at for me these next 3 months. I'm getting paid. Doesn't matter to me if the market finishes at an all-time high or sideways. It doesn't matter. The selling premium is where it's at.
Awesome. I love it, Jack. Thank you for that. We appreciate the insight. And I'll go ahead, Jack, and get, since the price has rocketed on Hood like it often does lately, I'll go ahead and get some updated prices from you and put those out tomorrow.
Yeah, you could raise that strike up a little bit. And
So,
Nate, I got to tell you, man, was I bummed out about that game. I know you were too.
Oh, let's not talk about that.
Oh, Jack, I was there.
Are they going to fire that dude?
I was there right up front. My face painted white, the whole nine. Didn't get the job done though. Steven was with me.
I saw
Such an
Nate's
energy drainer, man. I thought they were going to do it. I wanted Penn State so bad, but hey, what are you going to do?
I've seen that movie 100 times, Jack. Same one.
Yeah.
It was-
Nate, I'm curious. Have you ever been to a Penn State game where they won?
Oh,
Wow.
brutal.
All right. Well,
I'm
shots
starting to think
fired.
maybe you're the
You
problem.
know who your friends are now.
Hey, I've got a 50% win rate, so at least
There you go.
they ran over Iowa the last time I went up there. So, it was rough to watch, though. Nate, let's put that out of mind and talk
Yes,
about some
please.
exciting stuff. For those who don't know Nate Tucci, of course, this is his and Graham's show, so I'm sure most of you do. And I just bumped my camera off, so apologies for that. But he's got over a decade of experience trading everything from Forex to stocks to crypto and beyond. He grew his investment and dividend portfolio by over 100K last year. He hosts the opening playbook every Monday through Friday at 10 a.m. Eastern, and he's got a huge announcement to share with us in just a few minutes, which I can't wait for. But Nate, why don't we go ahead and dive into kind of what you're looking at in the markets and what you're expecting, how now that we're entering, as you said, unbelievably Q4 right now.
All right. Well, thank you, Stephen, for not making the first question about Penn State. That was very kind of you. Well, I mean, I guess I will just spoil it a little bit and say that I've got some thoughts here. I do think the market's unique, as my first slide there says, but I'm far more excited about the announcement that we have than anything else. Many of you know what I'm talking about, but it's going to take things to a whole new level. So I'm absolutely floored about that. But I do think we're in a very odd market environment. I think one of the most unique that we've had in history. Now, a lot of people have compared this to the tech bubble because, AI buzz, all that kind of stuff. But I actually think we're in a very different environment than that tech bubble right now. We could get into that environment, but right now. So if you look at 1995 to 2000, that's where the tech bubble got built. The NASDAQ was up, I think, 600%. The stock market was driven by mostly speculation. And there were some profitable companies in there like Microsoft, but mostly speculation. If you actually look at like the top 50 stocks that drove the NASDAQ, so the top half, you'll see that tons of them were operating at a net loss. So like literally not even profitable companies over that stretch. Very different than the environment that we're in today. So the companies leading the charge right now, since the COVID rebound, did have the bear market in 2022, certainly do have some hype. I mean, we've seen some pretty crazy moves. I think Hood's a great example. Tons of hype, but also a phenomenal company with record earnings. NVIDIA, record earnings. Microsoft, record earnings. And so we have company. Yes, we have hype. Yes, people are feeling that, kind of bubblish hype. But I think it's very different than what we saw in, the tech bubble that people are starting to kind of compare that to as if it's an apples to apples. If you go to the next slide there, Stephen, here's what you'll see. So I know that the chart's a little small. I tried to make it as big as I could, but we do see big bubble, quote unquote, leaders where they have a large percent of the market cap. Obviously, the Mag 7 has a huge percent. You see that's very similar. You even see that their cash on hand is, relatively low. Apple's now lower than it's been. It's 1.8. Amazon actually has lots of cash. We've got Google in there at 4%. And so you're starting to see like, oh yeah, it's a bubble. But then you go to the actual numbers on the profit margins. And these are the top companies. As you get below, it's actually even healthier, relatively speaking. But you get to that PE, 25, 26, 24, 25, 16. Then you compare that to 53, 100, 84, 86. You get the profit margins at 35, 50%, 30%, 34%. You compare that to 9, negative 1%. So this is, yes, a top-heavy market. Yes, an exciting technology-driven market. But we're not actually apples to apples kind of on the core underlying. Steven, if you go to that next slide, basically, I think if you believe that's where we're going, it actually is kind of good news for you. Like you think, hey, we're headed toward the tech bubble. Well, that basically means we're going to have a historic melt up to get to that level, right? Because the market would have to move so far to get to that level. So let me just give you 4 assets that I think kind of diversifying melt up assets. So we've got gold. I won't rehash some of the stuff that Graham already said. Great environment for gold. We've got small caps. Great environment for small caps. There you can see performance after first cut there, going back historically very, very strong. Aggregate up 11%. Also, we've got, go ahead to the next one there. Bitcoin, again, won't rehash what people have already said, but could melt up there and be, 130, 140, 150 if we get that kind of irrational exuberance, as one famous Fed chairman once said there on Bitcoin. And then, of course, the Mag 7. So I think what I would kind of call this is kind of a great divergence where I think we're going to have the really top companies that continue to put up record numbers, drive some other ones like Hood that are following suit. I think we're going to see small caps ride the wave. And I think the kind of the boring middle stocks probably won't do as well. They probably won't get similar actually to what we saw in the late 90s, where the S&P did great, but compared to the NASDAQ, lagged so far behind because of all the excitement. And so you kind of had small caps and NASDAQ way up at the top, and then the rest of the mid-market kind of trailing behind. That's kind of what I would expect. So if you wanted to trade all these opportunities together in a basket is all aggressive trades. Now, the caveat here is you should expect all of these to go to zero if we don't get that melt up over the next 6 months. Like these are straight up calls, which, as you guys know, I almost never trade. But if I'm going out 6 months and looking for a melt up opportunity, you can't get the totally unlimited upside potential with anything else. And so the idea would be trade out of the money calls on every single asset in here. Now, some of these prices may have changed because I did this pre-market. Obviously, the market is open and has moved somewhat. But you've got IBIT at $70, significantly out of the money. GLD at 370, significantly out of the money. MAGS at 68, significantly out of the money. IWM at 250, significantly out of the money. So if we don't get not just a move, but a big move, these are all going to zero. Let's be very clear about that. You've got $1,100, $380, $1,200, $600. So you've got about $3,000 that you are risking and could very easily go to zero if you do one contract of each there. But I guess my argument here is if you think we're going into that realm, which I'm pretty aggressively bullish here, I think that $3,000 could also flip into $10,000, $15,000, $20,000 if we get those huge outsized moves over the next 6 months. So that's a basket of just super aggressive trades that I think you can take right now if you, like me, think we have the potential for that big move. But I do want to mention a few other things there, Steven. I got a couple more things just to mention, regardless of the environment we get. So I personally think that the biggest miss retail traders will make here is basically, instead of doing what I just showed you, take a basket, be willing to risk it and see what happens, that they'll actually try to catch these opportunities with short-term discretionary trading approaches. Like, oh, Hood's overextended today. I'm gonna throw a put on for next week. Oh, Hood dipped. I'm going to throw a call option, or anything in between. I think where most people on the retail side fail is trading regular calls and puts, trying to time it up, trying to get those discretionary short-term moves. So I think that is a significant miss. The first thing to understand is that if we do get more bullish markets, which I fully expect, the moves likely won't happen when you think. So hint, this is a lot of what I talk about. Graham and I will dive a little bit deeper here in a minute. But if we get a massive rally, where the moves will likely happen is actually overnight. That's what that orange line represents for the last 30 years. So everyone thinking, hey, there's big moves coming, and you're trying to trade from the opening bell to the closing bell, you're at a really big disadvantage, even if the market is extremely bullish. And we'll dive into that a little bit here more in a couple minutes. The other thing to understand, and this is what I was mentioning earlier, is that retail traders jumping into this market, even if we do get this melt up market, will mostly get burned trading short-term regular options. I don't think that's just an opinion at this point. I think that's fact. I know I've heard Jack talk about some of the statistics around this. Even in good market environments, the people just buying up call options tend to get burned. They don't overcome the implied move. They hold it too long. They go too short-term. All of the combinations that happen there with retail traders trading short-term regular options, I think is probably the most difficult thing to do to be successful in this market. And so what I'm trying to do as much as I can is basically flip that on its head.
Absolutely love it. Thank you for those insights, Nate. A really cool approach to things as well with the basket trade. I haven't seen that done a lot. Graham, you have some insights to share here too, I think, as well. You want to jump in here?
Yeah, just what Nate had to offer there at the end, specifically about the short-term overnight trading, kind of goes hand in hand with what we've been working on behind the scenes as well. Nate's obviously led the charge there. Steven, you've probably seen a little bit of it, but we've had some crazy technological breakthroughs just over the last few months, leaning off the back of AI, some very, very impressive developers who know what the heck they're doing. They know the markets, and they're able to plug and play Nate and our brains into these tools. And we've got something very, very exciting to share with you today that's going to help folks really play off the back of that overnight phenomenon that Nate just mentioned there, the one that's been so powerful, not just this year, not the last year, not the last 3 years, but the last 35 years now. So a little over a year ago, I received an urgent call from options expert Nate Tucci claiming that he discovered a new way of trading. All right, so I got this call, and then he said it's one that allows us to place a quick trade before the markets close, right? Just at the end of the day, wait no more than 24 hours, and when everything works out as planned, watches the position automatically closes out with right around $500 overnight. more than 80% of the time. Now, after reviewing the data and placing a few of these trades myself, in fact, I've got one open right now. It's up 19% at the moment. I immediately had Nate get on my daily trade room on the opening playbook to shed lights on these overnight options. And if you were there and you paid attention, chances are you are loving these overnight options, as the live published trade results have been even better than we could have ever imagined. In fact, every day in the opening playbook, we get people at 5, 10, 12, 20 people bragging about how well they're doing here on the overnight options. Beverly up 6,000. Brandon, 27 trades overnight, 25 wins, 2 losers. Love this trade. Catherine, look at this, 87%. James, 35%. Jennifer, $869. Rock, you guys get it over and over again. Look at that. David, 500-ish a few times. And hundreds of more stories just like them. Now, as much as I'd love to spend the entire class just bragging on the success stories that we've been getting from students almost every single day, including that 81.2% win rate over the first year of live trade alerts, not a back test, real-time trade alerts, and the $30,000 in profit in the model portfolio so far, it's actually north of $30,000. Well, we've got so much more in store for you today, because thanks to those advancements in technology, the ones I was teasing just a moment ago, $100,000, over $100,000 worth of live options data feeds and some help from artificial intelligence, we're now able to take the shocking data behind these daily opportunities and merge it with an overnight market phenomenon that dates all the way back to the 1990s. And now what we're doing is amplifying those overnight options results you just saw. We're like the Fed is putting steroids in the economy. We're putting steroids in these overnight options. And this gives us more payouts than we could have ever imagined. I'm talking 3 to 4 times the opportunities at hand. Now, of course, we'll cover more on this in just a moment, so don't go anywhere, especially if you're currently a member. But before we get there, Nate, let's lay the groundwork on these overnight options. Why don't you show us how they work?
Well, I'd love to. And like you hit it at, I mean, these are all thanks to a unique phenomenon in the stock market that we sneak peeked a little bit there, and one that gives us a daily opportunity to target right around $500 in less than 24 hours. And yes, we are talking about a daily opportunity, because this is not a once in a blue moon type of opportunity. It's not once a month, doesn't set up once a week. Actually, we get a chance to target these 4 times every single week. For example, let's actually go back and take a look at April. Now, if you remember, let's just say that April was not exactly a pretty month. Over a 2-month stretch, the S&P slid north of 20%, considered an official bear market. NASDAQ was down 23%. Dow Jones was falling off a cliff. I mean, everything was ugly. And we got those Liberation Day tariffs that sent us down into the 5th worst drop in over 100 years in the stock market. But just to be clear, that literally did not matter to me or to the students following along with these trades. So if you start out with $2,500, you're not compounding, you're not scaling, you're not flipping all into the next trade. Here's some of the trades you would have got. So on Monday, April 21st, we'd have placed the first trade of the week. Now, folks could have automatically clocked out with $551 overnight from that trade. Then right back to the well, you plop down the next trade that same day at the end of the day. This time, $964 overnight. Rinse and repeat day after day. Wednesday, $543, real trade, by the way. Thursday going into Friday, $551, real trade. And all in all, it is a great week.
Yeah, Nate, I mean, we're talking $2,610 in overnight income that week. That's enough to double the stake. Now, that's north of $2,000 that obviously could have gone towards the groceries, the mortgage, the savings account, maybe some Danny Dimes rookie cards, which I've been stacking up on. Now, $2,000 in a week might sound like a lot of money to some of you, and maybe for others, it's not even noticeable. But regardless of who you are, where you stand, the one thing that I really love here is that we're not talking about hypothetical trades here. Each and every example shared today is based on real trades that Nate sent out to members and personally placed in real time. In fact, I've taken a few myself. I've got one on right now. And speaking of the members, your top students have been able to see results just like that over and over again. Here's Kevin, who said made over $3,000 yesterday with the overnight options. That's a one-day return for Kevin. Crushed it. Here's Ken, who said all winners in every trade. I'm averaging $2,500 to $3,000 per trade. So obviously you can start small or you can scale up here like Ken and Kevin did. $3,000 a trade. Very happy. Dennis here, 13 trades so far, 10 wins, $7,000 in profit. I've been trading a long time and never really thought about the approach Nate teaches. I like the limited risk, and I really like the set it and forget it process. And remember, all of that came from clicking a few buttons each afternoon and then watching as the position automatically closed out within 24 hours.
Yeah, I mean, these are real. It's as real as it gets. Real trades, real alerts that people are taking with real money. And my hope is by the end of our class today, we'll be able to reach at least one more person, hopefully a few more than that, and just help them start seeing some of these same results. Now, of course, let's be very clear. Not every trade is going to be a winner, guys. In fact, losers are part of the game. As always, we never leverage ourselves. We don't go all in saying, hey, tonight's going to be the night. That's not how we trade this. But the good news is overnight opportunities hit with about an 81.2% success rate so far. So, you're winning about 4 out of 5 days that you put down cash on these trades. And folks get to place a new trade each day the markets are open. So, for example, let's actually just keep going into that next week in April there. Now, while most people are fretting a recession, thinking about the global trade war, inflation, everything was getting crazy. If you guys remember in April, you could have literally ignored all that and instead just focused on these overnight income opportunities. Takes about 2 minutes each day to take advantage of them. So day one, $522. Day two, $445. Day three, $869. And then just finished off the week really strong there. Pretty much nothing burger day with $588 overnight.
Well, Nate, we're talking about another $2,425, nearly a double, hitting the bank for the folks following along automatically, which again, that's not all that crazy considering that many of your students have routinely posted even better results than that just recently. They posted it every day in the opening playbook, Nate. Every day. I get jealous. Here we have Henry saying netted 23%, $5,000 on it yesterday. It was sweet. Henry, that is
sweet. That is sweet.
Robin J says 16 winners in a row, small account. Robin started with $2,000 and is now sitting at $8,000. That's what, a 300% return on the account investment. Very, very impressive. And then there's Cheryl. This one, I mean, my goodness, up $20,000 for this week following you. That is just outstanding. So, folks, if you're looking for a new way to trade, one that doesn't require a ton of effort but has shown the power to pay almost every single day, then look no further. Because in the next few minutes, Nate is going to walk you through exactly how these overnight income opportunities work, that age-old market phenomenon that makes it all possible, and the newest options data set that now allows people like you to automatically close out so far with an 81% accuracy on the live trades. And get this, he'll even invite you to trade the next overnight income opportunity live with him, targeting another $500 or bigger payout today. And then plus, if that's not good enough for you, if you stick around, you're going to get a first look inside the new software that's now amplifying these daily opportunities. This gives us 3 to 4 times the daily profit opportunities, all automated, starting this very week, starting today for you guys. So welcome to the Overnight Income Project. We really probably should put a 2.0 here on this chart because it's just been upgraded and it is going crazy. Now, like I mentioned a moment ago, my name is Graham Lindman. You might recognize me from the Perfect Income Trade, which has reached over 100,000 people worldwide. Maybe you've heard of my wrap orders, which I think is a great way of trading. Now, given my trade track record, I normally don't take recommendations from other people. But when it comes to Nate, I always listen. And that's because despite having one of the most impressive track records that I've seen in the world of finance, including publicly growing a $10,000 stake to north of $50,000 in about 4 months' time, and also quietly generating over $100,000 in his slow and steady income portfolio last year alone. Well, you're not going to find Nate on Kramer's Mad Money. You're not going to see him on Squawk Box or CNN's Your Money. You're more likely to catch him hanging out with his family at the beach, or maybe at a football game like he did this weekend, watching Penn State, then you'll be catching him in New York City. But even though he's not strapped to a desk in a skyscraper in New York wearing a suit and tie, he's still been able to routinely deliver for folks over and over again across his strategies, especially with the overnight options. And guys, I'm not kidding. We asked the team, hey, do we have any stories from overnight options that have been documented? I think it was about 15, 20 pages worth of